In this, the 32nd lesson in the course, A Critical History of Economic Theory and Policy, we explore what William Jefferson Clinton and Tony Blair called the Third Way, a new approach to meeting the social welfare needs of society, not by demand management policies, but by providing the right incentives to market participants. The people of the United States seemed ready for a new direction. What that direction would be, William Jefferson Clinton and his team were about to announce to an anxious citizenry. Bill Clinton entered the White House in January of 1993 with a mandate to pursue his Third Way agenda. As a candidate, he promised to offer tax relief to families with incomes of less than $80,000 a year. He said he would raise taxes on only the wealthiest 2%, those with incomes above $200,000 a year. He proposed a surtax of 10% on those with annual incomes of more than $1 million. A month later, President Clinton delivered his first State of the Union message to the Congress. 2 decades of low productivity and stagnant wages, persistent unemployment and underemployment, years of huge government deficits and declining investment in our future, exploding healthcare costs and lack of coverage, legions of poor children, educational and job training opportunities inadequate to the demands of a high-wage, high-growth economy. Our immediate priority is to create jobs now. Some say we're in a recovery. Well, we all hope so. But we're simply not creating jobs. And there is no recovery worth its salt that does not begin with new jobs. A serious problem with the type of employment opportunities increasing in the U.S. economy was that few jobs involved actual goods production. Moreover, in the real estate sector, many construction jobs were being taken over by immigrant workers under non-union wage and benefit conditions. Although the labor cost component of housing construction was in this way kept stable, land and transaction costs skyrocketed. The parties who most benefited were landowners, realtors, closing attorneys, title insurers, private mortgage insurers, homeowner insurance companies, mortgage brokers, mortgage investors, and taxing authorities. President Clinton committed the nation to deficit reduction by a combination of higher taxes and reduced spending. He proposed to increase income taxes to 36% from 31% on couples with a taxable income of more than $140,000 a year and on unmarried individuals with taxable income of more than $115,000. An earned income tax credit gave tax cuts to 15 million families, and the average family with 2 children received over $1,000. His 1993 economic plan targeted a $500 billion deficit reduction over 5 years, requiring $255 billion in spending cuts. Britain's conservative government was also undergoing pressure from New Labour. Although Margaret Thatcher had won re-election in 1987, her campaign for a poll tax and other unpopular policy measures brought her into conflict with members of her own party. Her leadership was challenged in 1990, and she resigned as Prime Minister in November. Her replacement, John Major, was able to recapture public support, and the Conservatives won the next election in 1992. However, signs that Britain's financial system was unstable were substantiated when on the 16th of September 1992, the government was forced to withdraw the pound sterling from the European exchange rate mechanism after sterling fell below its lower limit. Currency speculators such as George Soros made huge profits by short-selling sterling. Soros committed to sell sterling at a stated price at a specific future date, then waited for the value of the currency to fall so he could acquire what he needed, sell it at the higher contracted price, and pocket the difference. For Soros, his gamble paid off handsomely. Germany was fighting inflation associated with the costs of reunification by raising interest rates, and the entire currency exchange system among the member countries was coming unhinged. Danish and French voters voted in favor of leaving, and on the 16th of September, Britain ended its efforts to prop up sterling and withdrew from the exchange rate mechanism. High interest rates were pointed to as the cause of yet another recessionary downturn in the UK, as more businesses closed their doors and the residential property markets crashed. However, Ron Banks, in a chapter of the book The Losses of Nations, edited by Fred Harrison, reminded readers of the role played by years of land speculation. The late 1980s were a period of ever-increasing land values, which terminated in the property boom and the recession of 1992. In April of 1993, the Conservative government announced that Britain's economy had grown slightly during the first quarter. The longest recession since the 1930s was declared to be over. However, British voters were starting to warm to the message of New Labour. At the same time, the Clinton economic team worked to come up with a plan that would both get people back to work and reduce the government's huge budget deficits. The Earned Income Tax Credit was expanded to cover 15 million working people, and taxes were cut for small businesses. Other measures created a long list of initiatives that together sounded like an activist agenda. Gross domestic product climbed during the Clinton years, but two components of real growth were actually declining: private spending on capital goods formation and public spending on essential infrastructure maintenance and replacement. The government's own analysis pointed to this real decline in public sector spending. The long-term implications have in recent years become a major challenge for government at all levels. What this graph does not show is that while total government spending continued to escalate and thereby contribute to the reported rise in the nation's gross domestic product, less and less of that spending was on bridges, dams, water and sewer systems, and even highways. However, let's look at another chart on the same spending. Spending data collected by the Bureau of Economic Analysis, published by Moody's, seems to be telling a different story, that infrastructure spending as a percentage of GDP has been increasing modestly since the early Reagan years. What might account for this apparent conflict? One answer may be in how the spending in dollars is reported. Neither of these charts indicates whether data indicates nominal or inflation-adjusted dollars. We should also remember how GDP is defined. GDP represents the total market value of all final goods and services produced, equal to total consumer, investment, and government spending, plus the value of exports minus the value of imports. Although government spending accounted for a declining percentage of GDP during the Clinton years, the level of government spending in dollars continued to increase. A high percentage of GDP growth also occurred in finance, real estate, and insurance, sectors of the economy that fueled speculation in the markets for shares of stock, bonds, mortgages, real estate, and of course land. Investors and investment managers struggled to determine whether the U.S. economy was expanding or contracting. Driven by heavy speculation in financial sector shares, the price of shares of stock rose 60% between 1995 and 1997. Corporations were reporting greater profits until halfway through Clinton's second term. What was changing? One key element was whether household incomes were rising, remaining stable, or were decreasing. The statistics indicate that inflation-adjusted median household income continued to increase during the Clinton presidency. This means that in 1998, half of all households had incomes of around $49,000 or more, and half less than $49,000. Even for those well above the median household income, the cost of rental apartments or housing units in many parts of the United States meant that as much as 50% of monthly income was absorbed by housing expenses. The situation for those within the bottom half was even more difficult unless they were fortunate enough to find government-subsidized housing. Although the poor as a percentage of the population was reportedly declining, income and wealth concentration was accelerating during the mid-1990s, despite the rise in property-related equity associated with rising land values. The actual number of people living just above the official poverty level made the government statistics look more favorable than the real situation. Official poverty statistics indicated the number of poor fell by 1.6 million between 1994 and 1995, from 38.1 million down to 36.4 million. The real decline, if any, was certainly far less. As Robert Pollin, professor of economics at the University of Massachusetts, concluded in 2008, under Bill Clinton, working people and the middle class lost out to Wall Street. Household incomes for the bottom 50% of the population were stagnant or falling. The percentage of people below the poverty line actually increased during the Clinton years, and gross income tells only part of the story. The bottom 20% of Americans received only 5.7% of all the after-tax income in 1995. Food costs increased by 18% from 1990 to 1998. The Consumer Price Index increased by 8% from 1995 to 1998. What continues to be the case is that the economic circumstance of seniors in the United States is strongly correlated to race and ethnicity. Persons of color disproportionately live below the official poverty line. Although 64% of older households incurred monthly housing costs at or below 30% of monthly income, the costs for half of African American and Hispanic seniors were significantly greater. Despite the rhetoric coming from Washington, the statistics were revealing a different unfolding story. New York University economics professor Edward Wolff commented in 1995, "We are the most unequal industrialized country in terms of income and wealth, and we're growing more unequal faster than the other industrialized countries." Over at the Federal Reserve, the chairman was now Alan Greenspan, appointed in 1987 to succeed Paul Volcker. In September, the Fed's Board of Governors met, concluding that the risk of inflation was increasing. They decided to tighten credit by raising the discount rate for lending to member banks. Alan Greenspan later recalled, "The Fed's hope was that the key markets, stocks, futures, currency, bonds, would take the change in stride, maybe with stocks cooling off slightly and the dollar strengthening." Whether speculators were astute enough to take their profits and get out of the markets or the economy was entering a stall, the month of October began with a 6% fall the first week, followed by an additional 12% the next. Somewhere around $500 billion in paper values had evaporated. Then on Friday, the 16th of October, 1987, the stock market fell another 22.5%, the largest decline in history. Greenspan describes how the Fed responded. The Fed attacked the crisis on two fronts. Our first challenge was Wall Street. We had to persuade giant trading and investment banks, many of which were reeling from losses, not to pull back from doing business. As all this was going on, we were careful to keep supplying liquidity to the system. The Federal Open Market Committee ordered the traders at the New York Fed to buy billions of dollars of Treasury securities on the open market. This had the effect of putting more money into circulation and lowering short-term rates. Though we'd been tightening interest rates before the crash, we were now easing them to help keep the economy moving. By 1989, Greenspan was faced with another great problem: how to deal with the collapse of the savings and loan institutions. Greenspan served on the oversight board of the new Resolution Trust Corporation, charged with disposing of the assets of closed S&Ls. Greenspan was now dealing with the Clinton administration. The Fed had brought down short-term interest rates to very low levels, and the economy was generating new jobs. Mortgage interest rates remained high as investors remained unconvinced that inflation was licked. President Clinton soon learned that things were worse than his team had thought during the election campaign. The Office of Management and Budget reported that unless new revenue was found and spending cuts made by 1997, the deficit would hit $350 billion. Clinton rose to fight the deficit. Critics accused him of giving in to Wall Street interests. Republicans and Democrats in the U.S. Congress rebelled, but the budget was passed by just one vote in the House of Representatives. It passed in the Senate only because Vice President Al Gore cast the deciding vote. As Alan Greenspan had optimistically told Clinton, long-term interest rates began to fall. By the spring of 1994, the economy was growing again. The number of unemployed people now began to fall. In 1993, 30-year fixed-rate mortgages dipped below 7%, and some adjustable-rate mortgage loans had initial rates as low as 3%. By mid-1993, mortgage lenders were processing 4 times as many refinancings as in 1992. Homeowners who refinanced during 1993 and 1994 saved $9 billion in interest. Homeowners with adjustable-rate mortgage loans experienced payment reductions of more than $18 billion in 1992 and 1993. What few analysts commented on was the fact that markets capitalized lower interest rates into higher and higher land prices. The greater the available amenities, the more desirable the location, the higher the prices rose. A 2006 working paper prepared by researchers at the Federal Reserve titled "The Price of Residential Land in Large U.S. Cities" confirmed the significant increase in land prices in many metropolitan markets, particularly in the Midwest and Southeast between 1984 and 1998. Median residential property prices increased from $121,500 in 1992 to $152,500 by 1998. For newly constructed housing, the average property price increased during the same period from $146,200 to $183,300. Much of the increase in property prices was the cost of the land. Newer housing units were also larger in size and came with upgraded amenities to help justify the rising cost of land acquisition. To counter the rising cost of land, developers reduced lot sizes, obtained variances to construct more units per acre, or acquired acreage more distant from employment centers. Rising land costs contributed to sprawl as developers chased affordably priced land to ever more distant parts of the nation's metropolitan regions. And of course, with the arrival of more households and businesses to serve them, communities were challenged to find the revenue to upgrade infrastructure. The nation's two conventional mortgage investors and issuers of mortgage-backed securities, Fannie Mae and Freddie Mac, provided fuel to skyrocketing property costs by annually raising their maximum loan limits, accommodating the high end of the market and exposing homebuyers to heavier and heavier debt loads. The maximum loan amount on a single-family property in 1992 was $202,300. By 1998, the limit was raised to $227,150, and loan limits in such high-cost markets as New York City, Boston, or Washington, D.C. were significantly higher. U.S. households were also taking on higher and higher levels of debt. Non-mortgage consumer debt, in blue on this chart, increased from $860 billion in 1993 to over $1.3 trillion in 1998. Mortgage debt increased from $3 to $4 trillion over the same period. Despite the fact that heavy refinancings enabled millions of homeowners to reduce their monthly payments, often by hundreds of dollars, personal bankruptcies started climbing again toward the end of 1994, reaching nearly 1.4 million in 1998, compared to 780,000 in 1994. The ability of millions of U.S. households to save declined throughout the Clinton years. One analyst concluded, "The mid and late 1990s will always be remembered as an era of unprecedented prosperity, but for most American families, the roaring 90s had a dark underbelly. It was also the decade of debt." Between 1989 and 2001, credit card debt in America almost tripled, from $238 billion to $692 billion. The savings rate steadily declined, and the number of people filing for bankruptcy jumped 125%. Late in 1994, the Federal Reserve Board decided it was time to tighten credit once again. Short-term interest rates were increased from 3% to 6% during 1995. However, this was the year of the dot-coms, and investors poured billions of dollars into the high-tech stocks. Yet another asset bubble was in the making. Across the Atlantic, the British voters returned Labour to power in 1997, led by Tony Blair. Blair also promised that new Labour would bring the nation into a general prosperity. Blair warned his fellow Britons the road would be long and require sacrifice. Blair stated, "It will take time, and we must never lose control of spending and monetary policy, because if we do, we will repeat the pain of boom and bust, of record interest rates, repossessions, soaring public debt, all the attributes of a Britain which, before 1st May, had for the last 20 to 30 years the least stability of any major economy in the world. William Jefferson Clinton, re-elected in November 1996 to a second term as President of the United States, would now have to respond to an economic climate characterized by what Alan Greenspan had described as irrational exuberance.